Hello, everyone, and welcome to Financial Accounting. Our topic today is preparing financial statements using accrual concepts of accounting, including a classified balance sheet. In the last 3 videos, we looked at the basic accrual accounting concepts, including the matching principle, used the accrual accounting concepts to analyze, record, and summarize transactions, and went through the end of the period adjusting process. You can find the links to these videos in the description below. Now it is time to prepare financial statements using accrual concepts of accounting. After we are done preparing the financial statements, we will look again at how they are integrated. A detailed overview of how financial statements are integrated can be found in the playlist Introduction to Financial Accounting. The link to the video is in the upper right corner. Let's first review the summary of previously recorded transactions by Family Healthcare, which is our sample company. We applied the accrual accounting concepts while recording those transactions. At the end of the month, we also recorded all necessary adjustments. On November 1st, Family Healthcare received $1,800 from ILS company as a rent for the use of its land as a temporary parking lot from November through March. This transaction was recorded as an increase in cash and an increase in unearned revenue. Unearned revenue is a liability account. On November 1st, the company paid a premium of $2,400 for a 2-year general business insurance policy that covers risks from fire and theft. This transaction was recorded as a decrease in cash and an increase in prepaid insurance. Both are asset accounts. On November 1st, the company also paid $6,000 for an insurance premium on a 6-month medical malpractice policy. This transaction was also recorded as a decrease in cash and an increase in prepaid insurance. Dr. Landry invested an additional $5,000 in the business in exchange for capital stock. This transaction was recorded as an increase in cash and an increase in capital stock, which is a shareholder's equity account. The company purchased supplies for $240 on account. This transaction was recorded as an increase in supplies, which is an asset account, and an increase in accounts payable, which is a liability account. The company purchased $8,500 of office equipment. It paid $1,700 cash as a down payment, with the remaining $6,800 due in 5 monthly installments of $1,360 beginning January of the following year. The company provided services of $6,100 to patients on account. This transaction was recorded as an increase in accounts receivable, which is an asset account, and an increase in revenue, which is a shareholder's equity account. The company received $5,500 for services provided to patients who paid cash. This transaction was recorded as an increase in cash and an increase in revenue. The company received $4,200 from insurance companies which paid on patients' accounts for services that have been previously provided. This transaction was recorded as an increase in cash and a decrease in accounts receivable. The company paid $100 on account for supplies that have been previously purchased. This transaction was recorded as a decrease in cash and a decrease in accounts payable. Expenses paid during November were as follows: wages, $2,790, rent, $800, utilities, $580, interest, $100, and miscellaneous expenses, $420. This transaction was recorded as a decrease in cash and an increase in expenses, which is a decrease in shareholders' equity. The company also paid dividends of $1,200 to the stockholder, Dr. Landry. This transaction was recorded as a decrease in cash and an increase in dividends, which is a decrease in shareholders' equity. Now that all transactions are recorded, it's time to record the adjusting entries. Adjusting entries are recorded at the end of the month. If you would like to learn more about how to record adjusting entries and what they are, please watch the video, The Adjustment Process. Prepaid insurance expired in the amount of $1,100. This entry was recorded as a decrease in prepaid insurance and an increase in expenses. An increase in expenses is also the decrease in retained earnings and shareholders' equity. Supplies used, $150, was recorded as a decrease in supplies and an increase in expenses. Depreciation of office equipment, $160, was recorded as an increase in accumulated depreciation, which is a contra asset account, and an increase in expenses. Unearned revenue of $360 was earned at the end of the month and recorded as a decrease in unearned revenue, a liability account, and an increase in revenue. Wages owed but not paid to employees, $220, were recorded as an increase in wages payable, a liability account, and an increase in expenses. And finally, services provided but not billed to insurance companies of $750 were recorded as an increase in accounts receivable and an increase in revenue. Now let's take a look at the summary of transactions and adjusting entries that were recorded at the end of the month. The exhibit on the screen has sections for the three financial statements: the balance sheet, the income statement, and the statement of cash flows. It also has a section where all transactions are recorded. The balance sheet section is presented as the accounting equation: assets equal liabilities plus owners or shareholders' equity. From the exhibit, the income statement will be prepared by summarizing the transactions listed under the income statement column. Then the statement of retained earnings will be prepared. The balance sheet will be prepared from the ending balances shown in the balance sheet column. Finally, the statement of cash flows will be prepared. Revenues are a result of providing services or selling products to customers. Fees earned represent services provided for cash or on account, and those accrued at the end of the month. Family healthcare has revenues from patient services and rental revenue. Revenues from the primary operations of the business are reported separately from other revenues. Since the primary operation of the business is providing services to patients, rental revenue is reported under other income. Expenses are matched against revenues to determine net income. Expenses now include depreciation expense of $160. Wage expenses of $3,010 include the $2,790 of wages paid, plus the accrual of $220 at the end of the month. Expenses not related to the primary operation of the business are reported as other expenses. Operating income is determined by deducting operating expenses from fees earned. Family healthcare reports an operating income of $6,030. Other income of $360 from rental revenue is then added to operating income to determine the net income for November of $6,390. In the statement of retained earnings, net income is added and dividends paid are deducted from the beginning balance of retained earnings to arrive at the ending retained earnings of $8,510. This ending retained earnings balance will be included on the balance sheet at the end of the month. The balance sheet on the screen is a classified balance sheet which has various sections, subsections, and captions. Assets on a classified balance sheet are normally reported as current assets, fixed assets, and intangible assets. Current assets are cash and other assets that are expected to be converted to cash or used up within 1 year through normal operations. These also include accounts receivable, prepaid expenses, and supplies. Fixed assets are physical assets of a long-term nature. Except for land, fixed assets depreciate over a period of time. Accumulated depreciation, a contra asset account to property, plant, and equipment, is included in the fixed asset section of the balance sheet. Family Healthcare reports $8,340 of office equipment, which is equal to cost of $8,500 less accumulated depreciation of $160. Intangible assets represent rights that will provide a long-term benefit to a company, but don't have a physical presence. Examples are patent rights, copyrights, and goodwill. Family Healthcare has no intangible assets. Liabilities on a classified balance sheet are also split into current liabilities and long-term liabilities. Current liabilities are due within a short period of time, usually 1 year or less. Current liabilities are to be paid for from current assets. Examples are accounts payable and wages payable. Long-term liabilities are not due for a long time, usually more than 1 year. As long-term liabilities come due and are to be paid within 1 year, they are reclassified to current liabilities. Family Healthcare has $16,800 of notes payable, $6,800 due next year and reported as a current liability. The remaining balance is reported as a long-term liability. Capital stock represents amounts invested in the company by stockholders. Family Healthcare has $11,000 of capital stock, which represents the initial investment of $6,000 made by Dr. Landry and the additional $5,000 invested during November. Retained earnings represent net income that has been retained in the company and not paid out through dividends. The retained earnings of $8,510 is the ending balance of retained earnings as reported on the retained earnings statement for November. The statement of cash flows is prepared by summarizing the cash transactions during November. Under cash flows from operating activities, cash receipts from operations are added and cash payments for expenses are subtracted to arrive at the net cash flow used in operating activities. Under cash flows from investing activities, the cash payment for purchase of equipment is recorded. The cash flows from financing activities will include the additional cash investment from Dr. Landry of $5,000 and dividends of $1,200. Let's take another look at how financial statements are integrated. The ending cash balance on the statement of cash flows is the same as the cash balance on the balance sheet. The net income on the income statement is the same as on the statement of retained earnings. And finally, the ending retained earnings balance on the statement of retained earnings is the same as the retained earnings balance on the balance sheet. That's all for today. Thank you for watching this video and don't forget to like and subscribe. More videos are coming soon.